Hi, I'm Phil McIntosh, the Chief Economist at Nasdaq, and today I'm going to give you an update on the economy, but it really wouldn't be right to not talk about tariffs and their global impact on what's happening in the economies and markets at the moment. But let's start at the beginning. I mean, the beginning of the year. What we had coming into this year was really pretty close to Goldilocks economies around the world. If we look at these GDP rates, you can see the US had a pretty strong amount of GDP growth last year, but almost all countries had avoided recession and was seeing growth that was not too hot and not too cold, as we would say, a Goldilocks kind of economy. We'd also seen that inflation spike that happened after COVID pretty much retreat back down to pre-COVID target levels of inflation in almost all countries in the world as well. And with that, central banks who are focused on things like inflation and full employment were able to start to pull interest rates down. And so we started to see interest rates, especially in Europe, coming down quite a lot, and even in the US coming down before the US election, and in UK as well. The expectation is, especially was, for interest rates to keep coming down this year into next year as things continue to normalize. And that was actually really good news for companies because when you've got falling inflation and falling rates, it's much easier to manage a company. Let me show you what I mean. This chart here looks at how wages in the green line had been going up because of wage growth for companies. So wage expense was much higher at the end of January than it was 5 years earlier. And input costs, so that you could see the COVID goods shortages and the spike in goods inflation here causing inflation or costs go up for companies. That had started to moderate as well. But really, if you're running a company, costs of wages, costs of inputs had been going up a lot, and both of those looked like they were going to continue to come down and be more manageable. And also, especially for small companies in the US, the high interest rates had actually started to chew away at their profitability. This is looking at the proportion of earnings before interest and tax that was being made up by interest, and it was getting close to 50% for small US companies. It had also gone up quite a lot for mid-cap US companies. So the smaller companies were really starting to hurt, and they have a lot more variable exposure, variable rate exposure, and they actually have some fixed debt that was becoming mature once we get through this year into next year much faster than the large cap companies. So small cap companies really did want rates to come down. But as we all know, markets have turned volatile. So let's talk about why. And let's talk about how the markets have performed. And what's really interesting is back in February 1, when President Trump announced new tariffs on Mexico and Canada and China, you can start to see equity market performance diverge. So China actually started to outperform, and pretty consistently, the US, which is the blue line here, had underperformed. Then, obviously, in April 2, we had the announcement of retaliatory tariffs. They caused the big spike in volatility. Markets around the world fell. And a week later, there was a reprieve, a 90-day tariff delay, only the first 10% rate going in. And so a lot of markets have since recovered pretty well. But what you see at the end of this period is the US is actually underperforming most of the other countries in the world. So the tariffs, even though it's America putting them in, they're actually hurting American stock markets more. If we look at uncertainty, you can see by this measure, this is a measure of economic policy uncertainty. And in the first Trump administration, it spiked up. In the second Trump administration, spiked up again. This level sometimes causes recessions. You can see the gray bars and the purple is recession forecast. And a lot of people talk about recession, and we're going to talk about it towards the end of this presentation. But so far, the uncertainty isn't triggering recession yet, but a lot of people's models are starting to forecast that it might. The other thing that people's models, well, can't forecast is where the equity markets will be by the end of this year. So this chart shows the range between the high and the low forecasts of analysts for the S&P 500. And you can see the blue bar, it is at record since the start of the century levels of uncertainty in terms of whether the market will be up or down and by how much. So experts really have got no idea which direction and how much markets will rise or fall. So let's talk a little bit about what's happened in the last few weeks. Why did the market react so strongly in April? And remember, April was when they put in the reciprocal tariffs, and we'd already seen some tariffs implemented, but the reciprocal tariffs, kind of by definition, were expected to offset the tariff differential between America, what America charges countries, and what countries charge America back for our imports and exports. And when you look at the size of the country is how wide the bars are, and the height of these blue bars is that tariff differential. And so a lot of the market was expecting that the reciprocal tariffs would be focused on these countries on the right, where the tariffs that they charge Americans are higher than what Americans charge them. But because the bars are thinner, it really wouldn't add up to that much of an impact on global trade. I guess we also knew that Trump had campaigned on a 10% across the board tariff, which is this orange line here, which is significantly higher than the blue bars. But what we actually saw on April 2 was the announcement of the reciprocal tariffs was much higher than expected. The average rate was over 20%, which is where this red line sort of shows you. And that was the reason the market reacted so much, was it was so much higher than expectations. It's getting such a bigger cost of doing business, especially if you're an exporter to American or if you're an American business importing products. Looking at the announced tariffs in a different way, you can see it was quite formulaic how it was designed. So all countries have a 10% base tariff rate. You can see that whether they have a trade surplus with the US or a trade deficit with the US. And then once you have a big enough trade deficit, the rate starts to go up. And so you can see the circle size here is the size of trade that the US has with that country. And obviously how high this dot is the rate that the reciprocal tariffs would have been charged at. So countries like Vietnam, a tariff rate close to 50%, really exceptionally high compared to history of America and even around the world. And if we think about what that math really was trying to solve for, I think this chart's a really interesting way to look at the, I guess, trade differentials in America. So the way to look at this map is the size of the countries is how much trade America does with that country. And the darker the red, the bigger the trade deficit America has with those countries. And so basically that formula attacked the redder countries, trying to offset the trade imbalances. That's what it's trying to reciprocate. And so all the blue countries are the ones that have the 10% flat, and then the red countries, the darker the red they are, the higher the tariff rate that they were assigned. Now we can think about what tariffs will do to the economy from looking at events in history. And it's quite informative. So if I get my little whiteboard out, I think there's going to be 4 main steps that we have to follow and have to work through in this tariff war. And the first step is kind of what's happening now, increasing in prices for inputs if you're an importer or if you're importing finished products for consumers. Then you're going to see countries retaliate against those tariffs because they'll want to protect their own companies and they'll want to protect their own businesses and economies as well. After that's happened is when companies can actually start to think about their supply chain adjustment. And when they do that supply chain adjustment, they may run into skilled worker shortages. Things like if you have to build a factory in a country that didn't have one, do they have engineers? Do they have construction availabilities just to build all those things out? So let's walk through with some real world examples how this should affect the market and prices and different companies. So this chart here is looking at Japan. Back in 2014, they increased a sales tax number. And the point of this is to show the first point, which is tariffs will increase prices, but they may not create lasting inflation. So with Japan, what happened was the prices went up by the amount of the tax increase, but then they didn't go up anymore because the tax increase was constant. And so you can kind of see that the blue area here shows that prices jumped, but they just stayed that much higher. They stayed the amount of tax higher. What happened to the actual level of inflation was for a year it was elevated, but then after that it went back down to normal levels. So the expectation is the tariffs themselves might not actually increase inflation by as much as people fear. The other thing that's going to happen is retaliatory tariffs. And so if we remember back to 2018 when the US put tariffs on China, China reciprocated or retaliated by putting tariffs on soybeans that Chinese were buying from American farmers. And what happened was the soybeans that American farmers were growing, they couldn't sell to China because they suddenly weren't competitive. And instead, the Chinese consumers went to Brazil and bought soybeans from Brazil. And we've actually seen that pattern persist ever since, basically the 6-7 years since. So there's winners and there's losers. And that's one really important thing to work out in this problem set. Everyone's talking very negatively about the tariff war, but there will be companies, there will be countries, there will be industries that benefit from what the US is doing. Some of the times the US will benefit from what it's doing. That's kind of the design of the tariffs. Then the third thing that happens is supply chain changes happen. And this needs to happen because otherwise companies that are importing products might be uncompetitive. They might not be able to sell their end product. They might not be able to sell the things that they're making offshore at all. And so we can see, again, with the China tariffs in 2018, they were targeted on China. So that makes this chart much easier to understand. China's imports to the US have halved in the 6 years. So not immediately, it didn't all happen at once. It took a long time and it was pretty consistent year after year after year. Companies worked harder and harder to reduce their tax burden and import products for a lower price so they could compete with other companies that maybe had different supply chains. The beneficiaries were some countries close to China, like Taiwan and Korea and Vietnam, Mexico, which you can see in green here, and even Europe to a little bit of a degree. So there was winners and there was losers created by the one-sided, I guess you could say, taxes on or tariffs on China. But it does help you understand that companies will change their supply chain. It might take years, and the winners will be where there is a competitive advantage created after that. The fourth thing that can happen, which might actually be more inflationary than everything else we've been talking about, is the supply chain shortages that might get caused if everybody ends up. The design of the tariffs is to bring manufacturing back to America. If all of the companies that currently import products into America decide they want to make it in America, we're going to need more factories, we're going to need more agricultural workers, more farm machinery. And so it's possible that you have worker shortages. And we actually saw an example of that coming out of COVID. So once the vaccines were available in the US, the manufacturing sector had already picked up because of all the stimulus checks. Then we saw a pickup in the services industry as restaurants needed workers back and hotels and airlines needed workers back and teachers came back full time. And so you actually had what we called the Great Resignation at the time, where there was a lot of people realized they could change companies or change industries for higher pay. And the job switchers, which is the purple line here, we're seeing salaries going up close to 10% per annum. Even the job stayers, because of that, saw their salaries going up. And actually, this wage inflation was probably more impactful in the inflation story that we talked about earlier globally than just the supply chain shortages that COVID caused. So there is a possibility that the shortages of labor and engineers trying to reshore and move production around will actually be inflationary in the longer term. But let's talk a little bit about what we know so far about where the impact might actually be. And I think what's really important, at least as a starting point, is to think about the American economy and how much it's changed. And so back in sort of the turn of the century, the US economy was very much more industrial and goods focused, much less services focused than it is now. So right now, the goods sector in America, which is what the tariffs are actually on, is around about 20% of the economy. The rest of the economy is services, and actually only a fraction of these goods need to be imported. So this is why the inflationary impact in the US is not as important as people think, because it's going to be a fraction of a fraction of a fraction of the total GDP that actually gets tariffed. If we want to look a little bit more detail at things like what sectors are going to be impacted, this chart's quite neat because what it does is it actually shows machinery, electrical equipment, and vehicles. The US imports far more than they export. And so this is some of the sectors where there is a deficit. And so those countries that have trade deficits with the US are probably making different versions of this. You tend to find the Europeans are exporting a lot of pharmaceutical products, Mexico and Canada and Germany, a lot of electrical equipment and machinery. Asia is doing a lot of vehicles, furniture. So there's different aspects per country, but there are definitely some sectors that are going to be more impacted by these tariffs, and whether those companies in the foreign countries, in Asia, say, are able to export as much in the future as they used to. There's some other aspects of the US economy, like aircraft and energy products, where actually the US is a net exporter. And so those retaliatory tariffs could end up focusing on things like this. And we've already seen China talk about not having Boeing aircraft imported into China. In terms of country exposure, a lot of the focus has been on Mexico and Canada, and there's a good reason for that because of their proximity, but also because of agreements in the past. There is a pretty integrated supply chain, and actually a really high proportion of their GDP comes from things that they export to the US. So these blue bars at the very top. So their economy exports a lot to the US. I think what's important for other countries to realize is most of their economies, so most of the Asian economies, most of the European economies, exports to the US are kind of a fraction of what the total GDP is really. So not as big an impact, especially if the exports don't disappear completely. If they go down by a quarter or they go down by a tenth, then the impact of the tariffs is going to be much smaller than maybe people are worried about. The other thing that I think is really worth highlighting is there will be winners and losers. And that's one of the things about a trade war. If we think about what we've already been talking about, obviously manufacturing is more exposed to a trade war. So if you're manufacturing chemicals, auto, we've talked about that a lot, you will probably be exposed to the tariffs. Whereas if you're in the services industry, the tariffs are on goods. And so much less exposed, at least so far, when we don't know what the retaliatory tariffs are. If you're in the cyclical space, so if you're on consumer discretionary where the consumer doesn't really need to buy things, they might stop buying things. Construction actually could do better if we all need to build factories in America. But for the countries where manufacturing declines, maybe the construction sector does stall. The defensives, when we think about healthcare, people are still going to get sick. Utilities, people are still going to need electricity and heating. And so all those sorts of industries are probably relatively protected. And so you can kind of look at this list and realize that there are potentially countries with higher reciprocal tariffs that will be a competitive disadvantage going forward. So countries with tariff deals might be better off. There's going to be winners and there's going to be losers. And I think that's important. And one great example already of potential winners is the European defense sector. And so this chart here is looking at the stock prices for a bunch of defense companies in Europe. Obviously, with some of the changes that have been talked about so far, with Europe needing to take a little bit more of an investment in its own defense and maybe increase its defense spending, what it's going to have to do is maybe invest in its own infrastructure and industrial capacity for defense. And so obviously these companies are going to stand to benefit. Germany sort of led a huge increase in spending already on the defense budget. And so these companies will be hiring engineers, maybe building new factories. There's winners that are going to come out of the tariffs. But that doesn't mean that we aren't talking about recession. A lot of people are talking about recession all of a sudden. And I think the reason, the most obvious reason why is if trade declines, then the companies that export things might export less, and that's just less that they need to produce, which means they need less workers. And so net, this could cause a slowdown, at least as a first order effect. One of the things we can look at historically is back in the 1930s, the US hiked the tariff rate pretty significantly. And there was a law called Smoot-Hawley, which increased tariffs. And what you can see happened is global trade, or the trade with the US, fell at the exact same time. And so if you make it more expensive to do trade, there tends to be less trade. That's kind of economics 101. And after that, tariff rates came down and trade went up. So the immediate impact is we will do less trade. So an exporter might need less workers. It might actually sell less product. That's probably going to slow an economy down. So far, the data really hasn't shown a slowdown. All of the charts like this one that look like something dramatic is happening based on surveys. They're based on expectations. So this is the CEO confidence index. And you can see CEO confidence looks like it's fallen to levels that had typically been really close to recessions. The risk with CEO confidence falling, and I've been talking to a lot of CEOs in America in the last 4 or 5 weeks since the tariff war started, they don't know where to move their supply chain. So they're not going to invest, even in America just yet, because they don't quite know what the end game is going to be. Do they need to really localize production here and in other countries? Or can some countries be used because they're relatively cost effective, bringing goods in at an earlier point? They just don't know what to invest in. So there'll be no investment. No investment means no construction, no new hiring. And that's going to slow the economy down just while we wait. And remember, we're sort of in this point of increasing input prices. We're not even at the retaliatory tariffs point in the cycle really just yet. If we look at what expectations are doing too, you can see CEO confidence is down, so is business investment expectations. And so, economies aren't going to be spending yet on their business investment. But what else is changing is there's a general expectation that tariffs will lead to higher inflation. Haven't quite seen it just yet because the tariffs are so new, especially with the 90-day extension. The higher tariffs aren't really going to come through for another 3 months, but the expectation is it's going to get more expensive to bring pieces of your inputs in or to import products that you sell in America. That could make products more expensive. So we're going to see inflation in the US. Ironically, if you're an economist, higher inflation, lower GDP growth isn't just a recession. It's a thing called stagflation, and it's really difficult for Fed governments to manage, because the way to tackle inflation is to put interest rates up and slow the economy down. The way that will actually slow the business down even more. So you kind of have a catch-22 with stagflation. If we look around the world, like we talked about at the very start, the GDP numbers were generally pretty positive when we started the year. A lot of economists are, because of what we just talked about, starting to wind their expectations down. But if you look at the countries that are most affected, it's those ones we talked about 5 minutes ago. The US is actually hurting itself quite a lot based on a lot of economic models. Canada and Mexico, because they export so much to America, and a lot of those exports might stop or at least reduce significantly, their economies are going to slow. At least that's what the models say, until they start to reinvest in their own economy or start to export to other countries. So the impact is actually way bigger in these three countries than it is around the world. But you can see almost every country, economist models have GDP falling because of the tariffs, even though at this stage, we're just talking about tariffs from America on American imports. But if we think about the tariffs, like I said, it's mostly soft data. And this chart here really shows it. If you look at the red line, that's the line that's falling really quickly. But that measures things like CEO confidence, consumer expectations, CapEx plans. We've also seen the stock market with short-term rates falling. Long-term rates in the US have been going up for other reasons. Credit spreads have been widening. Stock prices have been falling. The volatility index has been elevated, and it was a lot higher. So these are all forward-looking, like, expectation measures. Real data, like consumer spending and jobs and company profits, is still pretty strong. Manufacturing in the US is actually reportedly growing up until the end of last month. Real wages are growing and interest rates are falling, which is a positive for the consumer as well. So the net impact at the moment is not actually visible in hard data. And that's potentially important if we're going to talk about a recession. So a lot of people think a recession is 2 straight quarters of negative GDP growth. That's kind of an approximation of a recession. In the US, there's actually a statistical group, the NBR, that decides when a recession's happened, and they have these 6 factors. And when you see the factors, you start to realize why and that they make sense. So it's not just GDP falling. Industrial output needs to fall. Non-farm jobs need to fall. So employment getting worse. Personal income falling. Consumer spending falling, which makes sense if income is falling, which also probably percolates down to things like business sales. And you can see the last 2 big recessions that the US has had, those 6 factors were pretty consistently negative for months at a time, indicating a recession. Where we are right now, really it's only industrial output that's flat, and it's been ticking up. Everything else is really still quite strong. At least that's in the hard data, which is historic. And there are actually some models out there that say this whole tariff war, there's a scenario where it's actually a positive. It's a bit like the story we told a minute ago about the European defense sector, where countries are going to actually start to reinvest in themselves. They're going to spend more on infrastructure. They're going to spend more on reshoring. They're going to build industries and hire people. And that itself could actually increase productivity and boost their economies more than the tariffs and the loss of exports affect them. And so there are, obviously, these are 4 different scenarios, and 2 of the scenarios are negative. The scenario that's most negative is the tensions escalate, which makes sense. The fiscal reset is we kind of, I guess, settle about where we are now if we're lucky with a few trade deals. There's a short-term impact, and then the countries start to reinvest in themselves. But there is a scenario where things are actually better. And so that's worth remembering. Again, the media has been very negative on tariffs, and there's a lot of reasons why. But there are some potential positives, and it's almost certainly winners out there if you go looking for them in the right spots. So kind of to wrap up, let's go back to my whiteboard. The 4 steps of tariffs: increasing input prices. And in reality, we are still early stages of this. We are now waiting out the 90-day delay or postponement of the higher tariffs that the US wanted to put on the rest of the world. So because of that, we haven't really seen what the retaliatory tariffs are going to look like, or whether there's going to be trade deals. And if there are trade deals, what that looks like, and whether some countries become winners and losers or some industries get exemptions. Once we know all that, we should expect some supply chain adjustment. That itself is going to be an interesting thing to watch as companies move around where they buy products, where they buy inputs from, where they restaff, where engineers need to go. And that itself will filter through into how wages work and worker shortages in different industries start to appear. But there is a lot of uncertainty still to go. And I expect if you're watching markets throughout this year, that uncertainty is going to rear its head as volatility and price movements up and down as new news and data starts to come out. So I guess in short, we still have a lot to learn. And I'm sure we'll have an interesting conversation 6 or 12 months from now. Been Phil McIntosh, Chief Economist at Nasdaq, and I hope this has helped you understand the markets and the tariffs.